Welcome back to the Financial Symmetry Show. Mike Eklund and Chad Smith here with you this week. Mike, you went through an advanced program last year, right? That dove into some of these topics and many other topics as well that we may cover on future episodes this year. But we wanted to dive into this one because we've been getting some questions about how to deal with concentrated stock in portfolios. So that's what we're going to cover today. So Mike, you want to share a little intro there on maybe a little bit about the program you went through, and then we can dive into kind of what are concentrated stocks and how we deal with them.
Yeah, no, that's great. So I completed the Certified Private Wealth Advisor program in the fourth quarter of 2021. It really meant for helping high net worth individuals with primarily executives and business owners with advanced estate, stock or investments, tax planning topics. And one of the topics that was discussed in detail is, okay, I have a large concentrated stock position, either through stock options you might have, or you inherited the stock, or you're just lucky enough to buy Amazon in 1995. What do you do about it? Like, first of all, what is concentrated stock? What are your options? Because most people just say, well, you just got to sell it. Well, there are a lot more choices than just that. And so we felt that this kind of more advanced topic would be a good podcast episode. It is going to be a little more advanced than other ones we've done. So I just warned people in advance, but I think it will be helpful for folks that do have this question and issue.
And we will include links, and we're going to have a YouTube video with some slides that accompany some of these things that we're talking about if you want more detail on that. So let's dive in, Mike. Just describe in general, what's a concentrated stock?
Yeah, I mean, that's the first thing to start. Like, you're thinking to yourself, like, do I have this issue? Is this a problem in my portfolio? And I hate to say it, I sound like a lawyer, but it depends. It depends on what would happen if that stock went to zero. And would that impact your financial life? And if it is, then it probably is a concentrated stock. So that could be 5%, it could be 10%, it could be 50%. And that's where a good financial planner can help determine is this an issue or not, based on your lifestyle, your situation, and should you do stuff to kind of mitigate that risk. Because the good part of concentrated stock is some of the people on the Forbes 100 and the richest people in the world, Warren Buffett, Elon Musk, Jeff Bezos, Bill Gates, they gain their wealth through concentrated stock. The problem is you don't learn about the folks that the many thousands or millions that lost majority or all their wealth because they had a lot of stock that did not perform up to expectations.
Yeah, we've talked about this just in the big picture view of how individual stocks can, just the volatility of them and how they can impact you, right? But let's dive into that JP Morgan study we've referenced before, and they've updated that again.
Yeah, we're going to have a link to it in the show notes, but I think it's really helpful if you want to learn more information. But JP Morgan looked at individual stock performance from 1980 through 2019, and kind of looking at how the individual stocks did. So during that time period, 40% of the individual stocks actually had negative absolute returns, which means you started to invest at $100, with 40% of those stocks you invested in, actually the results were negative, where you ended up with less than $100. And that's over that 40-year time period. So that's a lot. That's 40%. 2/3 of them, which includes the 40%, 2/3 actually returns were below the index. And that's the index is really the Russell 3000, which is all stocks in the US. So 2/3 of it underperforms. You were just better off buying an index than trying to buy individual stocks because 2/3 underperformed in that situation. So that means as an investor, you have to understand, okay, there's only the chances are only 1/3 that I'm going to pick 33%. I'm going to pick one of the winners. Am I smart enough? Do I have the knowledge, expertise to pick those winners? Because as many Amazons I just mentioned or Apples, there also are the Lehman Brothers, WorldCom, Enron, GE, which has had negative 3% per year return for the last 15 years. So as everyone thinks they can pick the next winner, but there unfortunately are more losers than winners.
Yeah, and there's that great graph that we have of once the stock becomes one of the 10 biggest stocks out there, what's the performance look like going forward? So we'll include a link to that. So let's talk about the reasons that we hold concentrated stock. Why do we continue to let it grow?
I mean, there's a few. I mean, one is emotional. You as a previous employer or a current employer, you just feel like, hey, this is the best company in the world. I think I've mentioned in the past, but I started my career at GE. When I started there, this is the Jack Welch days, to kind of date myself a bit. But the view was you didn't need to own a mutual fund. You just own GE stock because they had exposure to financials, to healthcare, to industrials. Well, lo and behold, the stock has done horribly over the last 20 years, and so that was not a good choice. But people have that emotional attachment. They feel like this is because I know the company, it's going to do better than all the other alternatives. There's also the overconfidence, the belief that, hey, I hear a lot of that when people that buy Tesla stock. They feel like, well, Elon Musk knows everything. I love their cars, so I think the stock's going to triple in value. So that's that kind of overconfidence that it only can go higher. And then the other thing is you just got lucky and you bought early and you're holding it and you're not sure what to do. So the easiest thing when you don't know what to do is just not do anything. And I think that's kind of the third reason is people are kind of like, well, I don't want to sell because I don't want to realize taxes, but I'm not sure if this is the smartest thing. So maybe I'll just hold on to it for now.
Yes, not doing anything many times is the default there. We talk a lot about that behavioral side of economics and how that can impact you. So I guess the other side of the coin is, okay, I do want to do something about it. You make that decision. So you realize you're owning too much of this stock. You're feeling like I got to do something. So you could just go sell it, right? I mean, that would be one option, but let's talk about some of these categories because there's a lot of more advanced strategies that you could use to try to mitigate some of the risks or some of the negative occurrences that comes with maybe just selling a stock like that.
Yeah, and this is where we're going to get into more of the advanced discussion on the different options. But really, I kind of break it down to 4 categories. One is liquidity, which is kind of you need the money and the options there. Another is hedging. So you may want to hold the stock, but you want to kind of reduce the risk of it declining. Third is diversification, which is trying to find ways to kind of own the stock, but also kind of diversify your risk in terms of owning more individual companies as well. And finally is wealth transfer. Those are typically gifting to heirs or charities, and we'll walk through options there as well. But all 4 options. I will say we don't go into detail. We're not going to go into details on tax consequences in this podcast. We'll get high level discussion on what tax impacts would be, but highly recommend working with your advisor or your tax advisor to make sure you understand kind of the impacts, how each one would impact your personal situation.
Yeah, because many times that can be the biggest driver or complication, right? You've held this stock so long, there's very large gains. There's going to be major tax consequences if you do something about it, or if you just go sell it. So let's talk about those categories in detail here and dive in first to that liquidity and talk about some of your options there, if that's the need that you have.
Exactly. You need money for whatever you're buying a house or you're putting the kids through college, whatever else, and you need that access to cash. This is the easiest choice, just to sell it. So you can just sell it all. You can sell a portion of it. You can sell at the current market price. You could sell what's called a limit order in terms of wait till the price goes to a certain level. And so that is, one option. The pros obviously is you get access to the cash right away. So if it's, $1 million position and you sell, $1 million, you'll get that $1 million, net what you have to pay in taxes. The cons are obviously the tax consequences. And then also for a lot of folks that regret aversion where, if the price goes up further, you're always wondering, well, what if I just held longer? But typically for folks, kind of that tax impact is kind of one of the things that they don't feel very comfortable with because for whatever reason, this is not the year they want to sell. The second option, which is a more complex option, is what's called a variable prepaid forward. As I mentioned, it's a little bit more complex. You effectively get a loan for typically up to about 80% of the value of your holding. And then on the other side, what is done is effectively the position is hedged. And what I mean by there is the upside is limited and the downside is limited. And then within a typical time period, let's say 2 to 3 years, you're required to repay that loan. And that is through either shares or cash or whatever it is to prepay that loan. So the benefit is you get some money up front. It's not taxable at that point, so you defer those taxes and you retain ownership during that time as well. The cons is you're limiting. You have no upside during that time period, and your taxes are still going to be likely due unless you can deliver the shares when the loan matures. Your taxes are going to be due in that 2 or 3 year time period when it comes due. It's also much more complex from a tax perspective. You definitely want to work with your tax advisor on it because there's some terms or some requirements regarding how the hedging must work. So this is not one I would recommend doing on your own.
Yes, and that leads into our next category here, which is also one that you wouldn't want to do on your own because there can be there's so many pros and cons with these strategies, and you want to understand and make sure you're digging into all the details and how you're dealing with this. So let's talk about hedging in general of how you would your options there.
Yeah, I mean, this situation is if you want to sell, maybe you don't want to sell this year for whatever tax reasons, but you want to limit your downside. You're worried that the stock price will go from 100 to 20, and you don't want to lose 80% of your value. So, the common one is for most folks is what's called purchasing a put option. And that's just saying, hey, the stock price is at 100. I buy a put option that if the stock price, goes below $80, then my put option is in the money, so I'll get paid for that. So you're limiting your downside to whatever level you buy that put option at. The pros is it's limiting the downside. The cons is it's very expensive. So really, it's only recommended in a short-term time period. For example, if it's the fourth quarter of 1 year and you want to sell in the first quarter, you might buy a put option to kind of wait for that time period. But there's been a lot of studies that done that kind of the approach of trying to continually buy put options is not a very positive, from an investment perspective, given the cost of those puts.
Yeah.
So that's the simple one. The more advanced one is what's called the zero premium collar. So you noticed here, once again, we got the simple one first, which was the sale of the company or sale of the stock. Then we did the more advanced. Same situation with hedging. Put options is simple. The advanced is what's called a zero premium collar. That's the same as the first one. You still buy the put option below the market price, but then you simultaneously sell a call option above the market price. You use those proceeds from the sale of the call to buy the put. So effectively, you're not out of any money, but you've limited your upside and your downside.
Yeah. So just wanted to give you a preview that there are strategies around it, not ones that you want to use often, but there could be specific situations where you just want to explore it, maybe if you're in that situation, to see if it's the right option for you. But like Mike said, the cons there could be very expensive, could not work out.
Yep.
And that's the risk you're taking in trying to manage a concentrated stock position without just selling it and taking the tax hit. So, okay, moving to our next category. And this is one that is, I guess, likely one of the main drivers, I would say, or desires, right? Because you're worried about the stock falling. So you want to have more diversification. And that's the next category. We're going to talk about options that you have here.
Yeah, really a couple here. So this situation where you don't want to kind of sell and incur those taxes, but you want to, instead of betting on one company, let's say it's all your stocks in Amazon, instead of just betting in Amazon, you prefer say, I understand the benefit of diversification. I'd rather own 10 different companies because I feel like there's less risk there. And that's something called, there's a couple options, but there's one is called an exchange fund. Also, in another kind of advanced situation, this is what's called a private placement. You must be an accredited investor to do this, which means you must have, I think, a net worth of $2 million $1 million, and also income of 200,000 single, 300,000 married. But what an exchange fund does is you actually contribute your shares. It's not a taxable event, but let's say you contribute your shares of Amazon that worth, let's say 100,000 is this situation. In addition to that, other individuals like you, like Chad would donate his Apple shares, and Allison will donate her, Alphabet shares. Will all go into this fund called an exchange fund. The money must sit in there for 7 years. So it is a requirement for 7 years. And then after 7 years, the manager of the fund would then send you back, instead of just Amazon stock, they're going to send you a portion of Amazon stock along with a portion of Chad's Apple stock, a portion of Allison's Alphabet stock. And so now instead of just owning Amazon, you're owning 10 different companies. The negative here is it has to take 7 years and you don't have access to the money in the interim. When the money comes back, you can then decide if you want to sell it or do you want to keep holding it, but you would have a more diversified portfolio at that time.
Yeah, and that's what you're after there is de-risking a bit, right?
Yes.
You're adding that diversification, and that's something we've talked about in many other podcasts with strategies we use in our portfolios to diversify directly. But that could be an option again to de-risk there some on that concentrated stock. So our next one is, I would say it's one where we talk about more actually with clients regularly. And once you get into that phase of life, the later years, you're reflecting, not always though, right? Because if you're selling a business, it could be that it's one of the things you're looking at, but wealth transfer can be important for people. And there's a lot of emotional attachments that are hung up in this as well.
It's $16,000 to one person, but you could gift the stock. And if you go over that amount, then there's some additional IRS reporting, and it kind of impacts your long-term estate tax exemption level. But it's, you have 100,000 of Amazon stock. Once again, I just gift it to Chad. My basis moves to Chad, and then Chad can decide what he does with it. But it's a way to get it out of the portfolio. Now, the negative is obviously you don't have access to cash. So if you wanted to use it for spending or whatever else, you don't have any money for that. But it does remove it from your estate. And obviously, if you're giving it to a family member, they may be in a lower tax bracket, so they may be able to sell it for a lower capital gain that you would have. The cons are obviously from a state tax perspective, depending on how much you give. If you give more than $16,000 per person, that would impact your ability to potentially have a higher chance of paying estate taxes in the future. The second is you don't get if you're older, when you pass away, you get a step up in what's called basis. So if you bought the stock for $10,000, it's worth $100,000 today. When you pass away, your heirs get $100,000 value for their basis. If you gift it, the basis is only $10,000. So now it's a better tax situation for the heirs to wait, but it might not be they might not have the time or ability to do that. And then
that's awful nice of you, by the way, to give me that apple.
I'm trying to be generous.
I like your examples here.
Yeah, trying to be generous, trying to help Chad out here. But yeah, so that's a benefit of gifting to family members. The other things we've talked about in previous podcasts, I'm not sure which number, but something called a donor advised fund. So if you are charitably inclined, you could give that, instead of giving that $100,000 of stock to Chad, we could give it to a donor advised fund. And that donor advised fund, the nice thing is, so the gain, you don't have to pay any tax on the capital gain there. You'll get a deduction for taxes as a charity, assuming that it's not greater than 30% of your adjusted gross income. If it is, there's a carry forward, but this is where a tax accountant will help you to kind of determine the tax impact. And then once it's in a donor advised fund, the great thing about them is you can then gift that money out to charities that year, over the next 5 years, or the next 20 years. It doesn't expire. It's an irrevocable gifts. You can't get the money back, but it is, allows you to gift that to charity, get a tax benefit, and then, gift it out when you feel so choose.
Yeah, that's one. Just talked with a new potential client about last week, and one we talk about pretty often in a nice way, if you're charitably inclined to supplement some of those gifts. Now, what if you actually need some of the income from it and you still want to gift it to charity?
Which is charitable remainder unit trust, or what's called a CLAT, charitable lead annuity trust. There are a lot of different discussion points, but really the one I'll talk about, is, to keep it simple, is the charitable remainder annuity trust, or the CRAT. What happens there is, let's say that 100,000 example again, I give it to the trust, the CRAT. I pay no tax at that point, and that when that occurs. And then based on some actuarial calculations, I will get a monthly, almost like a pension. Let's say 5% of the value. I get $5,000 per year, and that amount is either based upon my life expectancy, depending on how old you are, or it's or no greater than 20 years. So there is an actuarial calculation. Usually, younger folks have to go with the 20 years limit. Older folks can get away with length of life expectancy. The key thing is, after you, let's say, I live 5 more years, I get $5,000 per year. At the end of 5 years, there's $70,000 left in the account. That $70,000 will go to the charity of your choice. So if you only live a year after the gift, the remainder will all go to charity. If you live another 25 years, whatever's left will go to charity. So it's a way to get some income today. You do get a tax deduction, but it's a lower amount than the donor advised fund. There is an actuarial calculation. It's based on what the expected remainder is going to be. We won't go to that detail today, but you do get some tax deduction, but it's just not going to be the same level as a donor advised fund.
Yes. So a lot of options on the charity side there to donate, potentially, if I'm interested, and ways you can work out if you actually need some of that money. So
yeah, exactly. I think the
stock.
Yeah, the CRAT or CRUT, which is another option, is a great option for if you want some of the income, you don't need all of it. You want to get rid of that gain, and that's and you still are charitably inclined. It's a great choice.
So then we have an other bucket here, right? Where there's a lot of, I guess, unique strategies to potentially stock options, or where a concentrated stock is held and what type of an account it's held in. There could be other options you could use.
Yeah, I mean, this is where we could have another podcast on these other topics. So I just wanted to kind of mention them, that they are other things as well. For example, if you own stock options and they're what's called ISOs, that's something you should consider from a tax perspective, in terms of when you exercise them versus when you sell them, and the time period between there, to get the advantage of lower capital gains tax rates. This is not an option for non-qualified stock options. Majority of stock options today are non-qualified, but I did have a few clients last year that had ISOs, and we took advantage of exercising them to benefit from a lower capital gains rate. This would be great for folks that maybe are in a startup company, or has a low exercise price compared to fair market value, to take advantage of a lower tax rates or lower capital gains tax rate. Mm-hmm. That's one. Another one that we folks don't really realize is what's called an 83B election. Its ability to kind of start the clock ticking on long-term capital gain rates. We have some clients that get, for example, carried interest, private equity interest, and it's a way to get that private equity ownership interest at a lower capital gains rate when effectively the company is sold in 2, 5, or 10 years from now. Otherwise, it would be typically that gain will be taxed at ordinary income, which could be a 20%, 25% difference depending on their tax rate. The other option, which is not discussed, if you have a 401k and you own a lot of your company stock in the 401k, some called an NUA, or net unrealized appreciation. It's ability to kind of pull out that individual stock and move it to a brokerage account, and pay tax a little bit on the basis on that, but its ability to kind of sell that the gain on that stock would be a long-term capital gain rate. Versus the alternative, what most folks do is they just roll it over to an IRA, and then all the taxes are at ordinary income rates, which are typically higher. So it's more of a tax strategy. You don't have to move all your employee stock to the taxable account, but you can do a portion of it based on the basis. So it's an advanced topic, but I think it would be helping out a lot. And the last one is what's called a stock swap pyramiding. This is a little bit unique in terms of you have stock. If let's say you have stock options, but you also own the stock, it helps. It's a way to use the existing stock you have to exercise the stock. So help to reduce that exposure through, because you might say, hey, I got my options coming up. I already own a bunch of stock. I don't want to own more. It's to help kind of, it's a way to use your existing stock to limit or reduce your exposure.
So yeah, this episode, of course, not for everyone, right?
Complicated.
It's specific to a need that you may have with a concentrated stock issue. It's a good issue to have in most cases. Obviously, it means that the stock you've held has appreciated. There's more wealth there, but with more wealth, many times comes with more responsibility. And the idea is that you're trying to make the best decisions you can with all of the options that may be out there available to you, not just option strategies, actual strategies to use. So our progress principle today is reach out to a professional if you are dealing with these issues, because there may be a strategy that you're not aware of, and we can discuss that to determine what's the best fit for that if you're dealing with a concentrated stock issue.
Yeah, and I'll rephrase what we said earlier. I think the worst strategy is to do nothing. When I say do nothing, is at least talk, as Chad mentioned, work with a professional. And the description or the decision may be, hey, you're fine, you don't need to do anything. But if not, then at least that professional, preferred a fee-only advisor, such as the folks here at Financial Symmetry, can help provide advice which is in your best interest and the best fit for your situation.
Yep. So the idea too that we have in providing this for you, of course, many of our podcasts are more evergreen. Some point to retirement ideas, retirement solutions, but this one was to just let you know, if this is your first time hearing us, that we do pursue other education to try to really understand all of the options for our clients. We care about what's going on. We are fiduciaries, so we put your interest first. And with that, we want to understand the best potential strategies for you. So many times that involves putting together a financial plan in the beginning and then keeping that plan updated so that we can understand what are the best choices and decisions for specifics like this as it relates back to goals that you have in mind for your family and what you want to come out of that. So we put together episodes like this every 2 weeks throughout the year in different ways, videos, podcasts, and articles. We have a long history now of doing this, and hopefully you can find what you're looking for in the magnifying glass on our website at financialsymmetry.com. And if you can't, please reach out to us. We love to hear from you, and we get topics from you most of the time. And that's how we come up with the episodes. So again, Mike, any closing thoughts there?
No, I think that was great, Chad. I think this is a summary to, like you said, concentrated stock's not a bad thing, but getting help to make sure you make smart decisions is the most important part.
All right. We appreciate all of you listening and look forward to catching you again in 2 weeks.